crude prices have been falling for the most part of this week. In fact, it's the 6th straight days that we saw crude trading in the red. However, the quantum of the loss that we saw last night was definitely the biggest we have seen in a very long time. Precisely speaking, in fact, the largest since December. It was almost a 7% fall in the Brent as well as the WTI. So while the Brent is of course holding on above $60 per barrel, the WTI has plummeted to sub $60 at around 59.97 the last time I checked. Remember, this is also coming after a great rally that we saw in the months of Feb as well as March that did push the market into backwardation. This we saw for the first time this year in a very long time. This is an indication that demand is strengthening and supplies are tightening, causing contracts for the nearest deliveries to trade at a premium compared to the later ones. Now, there are some reports suggesting that now the WTI has moved from backwardation to contango, which means that the future ones are cheaper than the current one. Now, there are several factors really behind this move that we are witnessing in crude prices. Firstly is the strengthening in the dollar, which in turn was because of the spike in yields. Everything somehow seems to be boiling down to that. But the strengthening in the dollar came to such an extent that the index moved to 92. And the dollar and the crude, given the fact that crude is in, denominated in dollar, do tend to move in opposite directions. Secondly, of course, is the fears with respect to the vaccination program. Many countries in Europe have decided to put their vaccines on pause, especially after the fears around the AstraZeneca vaccine. Of course, we did have the EMA saying that, look, the AstraZeneca vaccine seems to be okay, but still there is a fear that this is going to slow down the entire vaccination process. And what's more is that this thing is, coinciding with this resurgence in cases. Back home in India, we are seeing a massive resurgence in cases, almost 40,000 per day, a number which we saw last year. So this is as well causing a flurry of activity in the red. Now, let's talk about inventory levels. In the United States, yesterday we had the EIA saying that the inventory buildup was there, and that too higher than the quantum expected by the market. It's the 4th straight week that we are seeing US crude inventories building up. So that as well is adding pressure. Remember, crude processing rates in the US Gulf are stuck at about 80% of the levels seen before the winter storm hit the region, with refiners not really rushing to ramp up production with bigger than usual stockpiles to fall back on. So that as well is the reason why we've been seeing inventory build up. So it looks like, currently with the way things stand, this once again may not be a normal summer, and it's causing crude as well to correct a little bit, especially after we saw a rapid rally come by in February and March.